Happy holidays to everybody, and this is Mark Robertson, my friend and my buddy. Go on, Mark.
Well, thanks, Ken. Well, Merry Christmas and Happy New Year, everybody. Welcome to the December 2015 edition of the Roundtable. My name is Mark Robertson. I am joined here by, as you can see on your screen, I believe you can see the screen, right, Ken?
I hope so. Yeah, I'm seeing it.
Everything is all good. In fact, I'll switch it to the normal, the good display so that we can actually have good stuff here. That should be the full screen display. There we go.
That is,
I'm
yes.
joined here by our colleagues, and these are the four original Knights of the Round Table. We often have guest damsels and guest knights, but for tonight, we're joined by Cy Lynch from Atlanta. Greetings, Cy.
Good evening, everybody. Thank you, Mark.
Cy did get something to replace his Braves hat tonight, so we'll roll with that. And then Ken, the man who said no hats, no costumes when we first started this 5.5 years ago. And we do hats every once in a while. So Ken Cavula, good evening, sir.
Good evening to everybody.
The third night, again, the globe-trotting fugitive. He hasn't been feeling too well, so we hope he heals quickly and feels well for the rest of the holiday season. Hugh McManus from Pasadena, California.
Good evening, everyone.
Now, what these three guys have in common is literally decades of better investing, influenced, strategic long-term investing. Now, I know that's a mouthful, so let's just call it better investing. They've literally been buying good companies at good prices since before some of the people in this audience may have even been born, believe it or not. There are a few people that I saw, a couple younger people in the audience, and that's a great thing. Get started early. But again, I think this is a time of year when we really do pause and reflect a little bit. We might even do a little resolution type stuff here in a few minutes. But I do think it's a time to raise the glass, get some perspective, celebrate. We've had quite a strong year with the selections in the roundtable. We'll see that as we go forward. But again, reflect, pause, learn, share, lean on each other. All those things are valid things to do at this time of year. Let's get the legal stuff out of the way first. Again, no investment recommendation is intended. Again, I saw all kinds of familiar names. Welcome back. A few new names on the list. If you're here for the first time, it's pretty much wide open. When you are asked to vote in the poll at the end of the session, please feel free to vote. The Q&A is wide open, either verbally or across the question box on your right-hand control panel. But again, the stuff that we talk about here is really to illustrate and demonstrate. We're big on the word demonstration here at Manifest Investing and Better Investing. We're demonstrating a philosophy and a technique that has served literally hundreds of thousands, if not millions, of investors over the last 70 years quite well. And all we're doing is trying to take real case studies, present our best stock study ideas at this time, and just go over them and demonstrate that process. If you have any questions, you can write to me at that email address at the bottom of the screen. And if you or a friend would like to be added to future session reminder list, nkabula1@comcast.net. That is Ken's better half, Natalie, that takes care of that for us. So let's go ahead and press on. This is kind of our standing agenda. Again, welcome to all of you, especially the newcomers that are here. We're going to take a quick look at the results that we've achieved, quick reminder as to what we're trying to do. Maybe talk a little bit about resolutions, but I don't think we'll spend a whole lot of time on that. There really isn't a challenge. We often will put a company on the hot seat and challenge, but nothing came to the fore, and the portfolio is in pretty good shape overall. Then we'll go into our four presentations. You can see the companies there. A couple repeats in there, a couple new ones. And then we do close with an audience poll. What isn't on there is any time left over is for wide open question and answer session. Here's a quick reminder of what we're doing. Everybody that comes here brings in investment opportunities. Some of them are unusual. Some of Hugh's are actually regarded as non-core or speculative, and there's a few other people that participate that do that also. But most of the positions really are going to be the type of core investments that we talk about that should make up the lion's share of most portfolios. We do aim to bring you ideas that beat the market by 5 percentage points over the long term. We measure the market by the Wilshire 5000. You'll see that. And we really do like to see at least 3 out of every 5 selections outperform that benchmark over time. Here are the results. Again, we've been doing this for 5.5 years now. The selections that we have made, we keep in a tracking portfolio. We actually track their internal rate of return and compare that versus matching or mirroring investments in that Wilshire 5000. The tracking stocks have actually outperformed the market by 2 percentage points. The actual rate of return, absolute rate of return, since inception is 12.6%, as you see there, which isn't too bad. Again, beating the market by a couple of percentage points. We'd like to see it get up to 5 over the long term. And the outperformance has been okay, but we'd like to see that be a little bit stronger too. So again, relative return is just literally taking the actual result achieved and subtracting out to compare what would have been done in just a regular old Wilshire 5000 index fund investment. And again, our objective is to beat that by a few percentage points. Again, 2% is probably better than good. It borders on great. 5 is out of this world, and 10 is, I don't know, out of this solar system, whatever. And so we would like to see it get up to that 5% level over the long term. Any questions or comments at this point, Ken?
No, we're pretty clear at this point, Mark.
Okay, we'll keep rolling then. You can actually look at the companies that are in that have been selected either by any of the knights, guest damsels, or the audience. Again, the audience actually chimes in at the end, and we keep track of them on a dashboard at Manifest Investing. This is public, so you can actually go to that link anytime you would like. And we keep track of the number of repeat selections in that legend up at the top. So at the very top, in fact, we're joined here by Cy Lynch here tonight. I believe Cy is responsible for 9 or 10 of those cognizant selections. And very, very true to the long-term better investing nature of what he does. What that means is we take and invest $1,000 every time we make a decision on a stock. So Cognizant Technology has been selected 12 times, as you can see on here. And the 12 times where it's been selected, which you can see here in the legend, would mean that $12,000 have been invested in Cognizant, and that is now worth $19,000. So you can literally break it down for any company, pick any company on the list. What would be a good one to look at?
Well, Mark, back in November, we had a program in mid-Michigan talking about our stock contest, and we're talking about stocks that everybody knows and how well a lot of them had done under the radar. Look at the third one down. Look at Microsoft. That's been picked 5 times.
Yeah, that's an excellent point. I mean, we had to be very patient to get to that point for many of us, but as Ken is saying, it's only been picked 5 times, and it's way more than doubled. So I think at least 3 of us have picked that one over the longer term. You know, Bank of America has been a fairly non-traditional selection that he has made over time, 4 times, and that has also almost doubled. I mean, you're starting to see a theme. They don't all work out quite that well. Let's pick an example that hasn't. Qualcomm. Qualcomm's been selected 9 times. There's probably a few Qualcomm shareholders in the audience. $9,000 invested in Qualcomm. In fact, I think I'll switch ink color for this one. It's kind of painful, but Qualcomm 9 times selected, so $9,000 invested is now $7,500. So that one's backed up a little bit. Some of us in the audience believe that they will work out their troubles. Others are beginning to wonder if there isn't some long-term damage there. But from top to bottom, pretty good performances. I highlighted Mesa Labs. I'm going to use that one tonight. Again, that's on the list. It's been selected 3 times, and it's up to $5,600. So again, you can kind of break them down and decode. And again, if you go to that link, you can see all the selections, including the single-time selections. We had some fun a month ago with one-hit wonders, where we looked at stocks that had only been voted for 1 time or selected 1 time since we got started. So.
I have a question, Mark, for Hugh. Hugh, have you lost patience with Staples at all since the scuttling of the merger between Staples and Office Depot?
I haven't lost patience. I'm digging into the numbers in a little bit more detail, and I had hoped to have something tonight, but didn't have time. But we'll do it at a later date, just dig in a little bit more into staples.
Okay.
Yeah, it's actually come back, and I think it's almost cut in half from where it was at one point.
Mm-hmm.
So
The thing to remember about Staples, it's a sleeping giant in the sense that it is the second biggest online retailer, and it just has to get to terms with its footprint on the ground with the number of stores that it has, because it just has too many.
yeah, and,
It hasn't cut back.
and they actually had a major news item within the last 30 days. The battle with the government. Care to elaborate on that, Hugh?
I haven't gone into the details on that. I've read through the press releases, but I want to dig into it in a little bit more detail, and that's why I'm digging into the numbers.
Mm-hmm. Basically,
Mark, we have an interesting question from Roger. He says, how do I tell which ones of these are core holdings and which ones are non-core holdings?
well, anybody can chime in on this one. I'll give you my quick answer. It's in the eye of the beholder. And literally, I think of a core company as a company that has high quality, fairly established track record, usually a very high financial strength. I know Cy likes financial strength, but a core holding to me is one of those up, straight, and parallel where the quality is high, the earnings per share stability or the consistency of the company is high, the financial strength is high, basically saying it's got a strong balance sheet. Any other thoughts from any of you on what makes a core company?
My definition consists for core holdings, a huge part of it is financial strength. I use your quality rating, the manifest quality rating. I want to see a quality rating for a core holding. I like to use 85 as a benchmark, and I like to use financial strength at 85 as well for my core holdings. And I also like to see a fair amount of EPS stability, and I use 70, 75 as the benchmark for that kind of a holding to differentiate it from one that I would be willing to trade if something better came along.
I would echo Ken's. I'd probably go 80 and 80 under most conditions. That's 80 financial strength and 80 quality, but the 85 is good. I don't look quite as much at the earnings stability for that because I think you're going to have pretty good stability with those two companies, but where you don't, with at least in my experience, and let's see, Apple is an example. Notice Apple, although that does meet Ken's standard just barely at 76, if you actually look at Apple's line, it's primarily a lower earning stability than much of those high financial strength and high quality companies because it's actually had very strong growth. Sometimes if the growth is too strong, and it's curving upward rather than going straight in a linear up. It's hyperbolic in its increase, which Apple was for a while. That will lower the stability line, but I would call that a good company still.
Yeah, absolutely. Apple didn't meet my stability characteristics, but when I see a line shaped like a parabola, I'm pretty happy with it if it's going up. So.
Right, yes, you don't want it the other direction.
As long as it's not one of the Roman candles. And now, the other way to look at it is when you look at a visual analysis of the company and there's no earnings, that pretty much tells you you're dealing with a different animal. Sometimes Hugh will dabble with some of those. And nothing wrong with that. I mean, I'm just saying every once in a while he will go after some of those type of companies, and I've seen him achieve spectacular returns in that type of environment, early stage investing and all that kind of stuff.
Mark, Roger is...
I was just going to chime in there, and this would be non-core, is that not everyone, but many people have an inclination to put a certain percent of their portfolio at risk. A certain percent is usually 1, 2, 3%, a small number. And I try to steer clear of total gambling when you do that. At least do something that can foster your education or improve it in some way, and I do that at, say, for pharmaceutical companies, where both professionally and economically it has benefited me greatly. But if you are prone to put some of your portfolio at risk, do it in a kind of a rational way. you know.
Mm-hmm.
But for core holdings, I echo what I've heard. It's really stability, financial strength, longevity, stability in the key factors we all look at. And many of those are in the stock selection guide.
Yeah.
Mark, Roger is following up by saying, so the 25% maximum non-core requirement is pretty subjective. And I would answer, yes, it's very subjective. And there's no necessity for any portfolio to have any non-core holdings if you're not really comfortable with that type of investing.
Yeah, you certainly don't need to. But they can be extremely rewarding.
Absolutely.
I mean, I've seen Hugh do it that way. And for those of you that are worried about Hugh, he's got plenty of core holdings in his personal portfolio.
I just think back to Hugh's choice of Amazon at the convention 2 years ago, Mark, and I'm thinking I wish I would have just, bought 100 shares of Amazon when Hugh mentioned it, because it's certainly not a core holding, but certainly has been a wonderful investment in the last 2 years.
Yeah, and I think it's a 2-time selection. It doesn't show up here on the roll call, but I think he chose it twice, and that's in a couple of years, folks. So I mean, it's probably the top performing stock in the stock market this year. And again, there weren't any boos coming from the audience, but it was kind of close, And I was in agreement. I'm with Ken. I'm like, boy, after listening to Hugh's presentation in Chicago, I'm like, I'd like to throw a couple dollars at that one, just because it's different. If you want to dig in a little bit deeper on that, you can do that at Manifest also, and we do a price to cash flow analysis because that's what Amazon cares about, and you can have some fun. But let's go ahead and jump out of here for now. I'm just going to give the quick report card to say that our average return of the tracking portfolio is about 12%. That's actually a little short of where we'd like to be, so hopefully we'll pick some good stuff tonight. But the growth is actually pretty good. This could be a little bit higher. We'd like to see that in the 11 to 12% range. It's about 10% on the average growth. And the quality, again, is okay. Wouldn't hurt to be a little bit higher also, but these three parameters, the return forecast of the portfolio at 11.9%, the quality at 84 is still excellent, and there is enough growth. That means there's enough smaller, faster growing companies to keep that high enough. We'd like to see it a little bit higher. That's why I'm sure all of you are going to vote for Mesa Labs tonight. No, just kidding. just doing a little bit of warming up, you guys. So let's go ahead and spend a moment just kind of talking a little bit about any resolutions. We're going to kind of just go around the table, keep it brief, but what are your thoughts on New Year's resolutions? Who would like to start with respect to investing?
Well, Mark, I'll jump in. My wife and I have actually been talking about resolutions for the new year as far as our investments are concerned. We're well into the Medicare generation, and we're comfortably retired, and we've decided that a resolution that we have to make is to try to get ourselves out of the saving mode and get ourselves into the spend and enjoy it mode just a little bit more than we've been in the last 10 years or so. And that means not being quite so frisky with some of our stock investments, and maybe becoming a little bit more conservative, a little bit more focused on dividend, and trying to stay away from some of the long-term, very speculative plays that we've been very fond of over the last 30 years. So that's a gentle shift based on age that we're pushing towards. We're going to try to spend some of this money. Our kids don't need all that we have, and even if they think they need it, they don't. So we're going to try to spend a little bit more than we've been spending in the past 10, 15, 20 years, and maybe move away from very many of the non-core holdings and move into almost entirely core holdings in our portfolio.
So does this mean that my adoption is back on the table at all, or?
No.
No, it doesn't. Well, I just thought I'd throw it out there just in case you were. I think it's admirable that that you guys are thinking about enjoying some of what you've very carefully built. And I think it's admirable. Cy, how about you? Anything?
Well, sure. I first of all will thank Ken for spend and enjoy it mode because I'm doing a class on when to sell at Bink this coming May, and that is one of the reasons for selling that I see that sometimes we don't mention, and I like the phrase spend and enjoy it, so I'll probably plagiarize it. As far as resolutions, I have one personal that I'll mention, and one that I think I have learned in my 30 plus years of investing, but I would offer it to everyone in the audience. The personal one is to find a little more time to manage my personal portfolio. I've kind of, between entering the ministry and being a full-time student, I have not, of course, couldn't watch my portfolio anywhere near as close as I did when I did it for a living and did it even as a hobbyist. But I would like to watch it a little closer. However, the beauty of it is the portfolio is still doing just fine, even though I'm not able to watch it quite as much as I would like. So a little bit more regular active involvement in my portfolio is my first resolution, and that's the personal one. The second one, and I think is important to remember as the market remains at near all-time highs, as the market has bounced all over the place over the last 12 months, looks like ending the year relatively flat, although thanks to today, we're up several percentage points. And then, of course, going into the fourth year of the election cycle, which can be a turbulent year as well, is to stay the course. If you have not experienced a bear market or have only experienced one or so, trust the system. The methodology of long-term investing in high-quality growth companies selling at good value, the better investing method, the manifest investing method works. And so I would encourage everyone to resolve to stay the course no matter what ridiculousness we hear in the next year.
Fantastic. Yeah, that's what I would expect you to say, because you and McManus are such long-term focused people. So, Hugh, any thoughts as far as your resolutions for this year?
Well, for me, it's you know, the change of jobs and so forth. I haven't been as diligent about investing regularly as I had in previous years. So I need to get back to that. Doing if I can do it, a weekly thing, finding a company and investing in it. It's just an accident that I've hoarded cash this year. It's just because of all the travel and meetings during the day. But yeah, I need to get back to that a little bit more diligently. That's the biggie. And I guess monitoring the portfolio a little bit more closely, which I haven't been doing. But that's not necessarily a bad thing.
No, not if you build them like we do. A lot of times people are stunned when I admit how infrequently I look at our stuff when our family accounts and everything else. So you don't have to look at it every day, and you don't have to dial up CNBC and all that. Well, as far as I'm concerned, my most successful year ever with resolutions was the year when my resolution was to make no resolutions, and that went pretty well. But I do have a few this year, and it actually lines up with what Cy and Hugh said, and in fact Ken, in terms of perhaps even ratcheting up a notch when it comes to support from manifest investing on some of the decision tools and the alert tools. And I don't want to go too deep into it here, but I would really like for manifest investing to offer a relative return-based trigger. And those of you that have been around the roundtable for quite a while, you'll remember some of those moments when I would select a stock and I would say, I think I'd like somebody to kick me if I ever fall to a relative return of negative 20. And because if you hit minus 20, sometimes they go to minus 40, minus 60, minus 80. Those are the ones that can really hurt you over the long term. And you can actually put a stop to those. I've never been a fan of just simply picking a number like Mr. O'Neill does with the canceling method, where he says, basically stop out of any stock at -7% from when you bought it. I think that's vulnerable to, what if the market went down 10%? So I think sticking to our notion of relative return, watching for one of those and being willing to admit you may have missed something or may have even been wrong. I make plenty of mistakes, and I think building some of those type of tools and revving up some of the stuff that Kurt has done is outstanding. We just need to take it to the next level with respect to the alerts and help people learn how to use them. I will celebrate here at the end of the year. Many of you already know the story. If you actually read the cover stories, I had gone years wanting to buy Novo Nordisk at the right price, the right return. And I missed a few opportunities over the last few years, and the alert system actually triggered the purchase of that company for my long-term core portfolio this year. So that's an example of where the stuff that we do, the type of tools and technology that we can offer, can actually help with some of this stuff. And it's frankly, it's the reason Manifest Investing exists, to help people use some of these time-honored philosophies and tools over the years and put them to work. And again, I'll second what Cy had to say. If you're a young person with a long time horizon, or even a more senior person with a high risk tolerance, be like Tin Cup and don't think about market timing or asset allocation, all that kind of stuff. Stay the course. Pick good companies at good prices and just press on. You look at the history of the Tin Cup model portfolio, it bounced back from that Great Recession, in blazing color. And that's the type of thing that you can do, even with a fully invested portfolio. You don't have to get cute at this stuff. And like Ken was saying, you don't have to do the non-core stuff. I do think it can serve a purpose if you want to tinker a little bit with a small percentage, as Hugh said, but you don't have to do that either. So again, I guess the resolution is stick to the knitting. One of the things that you will see a little bit more from us, you'll see it at the end here tonight, workshops all around the country. We are going to try to get out a little bit more than we have in the last few years. My situation has changed a little bit, and there's a little more availability, and Ken and I all four of us like nothing better than getting with you guys face to face and getting an opportunity to share some time and share some ideas and thoughts. So hopefully there'll be more of that. If I had one resolution, it would be for more of that, and reinforcing all of those core concepts over time. So with that, I think we'll go into the stock presentation. Unless anybody has any other closing comments about resolutions, we might get some questions in the question and answer, but I say we press on for now. You guys good with that?
Mark, we're up to date on the question box, Mark.
Okay. Well, let's go ahead and jump into this. This actually is one of our featured stocks very recently, Scripps Networks, and so I would like to bring it to the attention of the audience tonight. Take it away, Mr. Lynch.
All right, thank you, Mark. And yes, Scripps Networks is my stock of the month, and it was featured as Mark mentioned, and also it will be featured in the growth stock outlook column that I write for Better Investing in the January issue. So great minds seem to think alike. As you can see from this chart, it's a pretty solid up straight and parallel company. A little bit of volatility in the Great Recession that you don't see exactly here, because the company went public, I believe, in 2008, and the chart that I use has some pro forma data going back into 2007. So there's a little bit more volatility in that earnings line if you add the 2007, but you can see that it's a very consistent company. As I usually like to do in these presentations, I'd like to mention where the idea came from. So next slide, Mark. This month I did just a very simple screen, and actually I don't know if this is your mistake or my mistake, Mark. It must be my mistake, because this is actually from my July presentation. Check the next slide just to see if, Yep, that's the one I anticipated.
Well,
All right, well, I will apologize.
No, let's go ahead and we'll bail out, and we'll go
Yep.
there right now, and it's
All right.
probably what you expect to see right now.
Yep, and I just happened
We'll
to
do it
call up my copy too, and I don't know how I messed that up, Mark, but anyway,
I think
it's me, not you.
this is what you want right here, live.
Yes. There you go. You see Scripps Network in the Sweet 16 screen that you get whenever you just call up the company investments. And I believe when I saw it, it was actually third. But this is the point. Cognizant Technology is right there at the top, which everyone knows is one of my favorites. And Scripps Networks was the second. And so I decided, since it was a new company, because I decided I would go with a new company tonight as opposed to a repeat selection of something that was in the portfolio, either that I had picked or someone else. So I chose Scripps. And for those of you not familiar with Scripps, you can go to the next slide, Mark. It's actually well over a 100-year-old company, about a 140-year-old company, going back to the E.W. Scripps company that had print media, and then in the 90s started branching out into broadcast media and into multimedia, and then in 2008 spun off Scripps Network, which is the holder of, you can see five networks are their primary networks: HGTV, DIY Network, Food Network, Cooking Channel, Travel Channel, and Great American Country Channel. And each of those networks also, many of them have international affiliates. Food Network for one, and they have also just purchased a controlling interest in a Polish network, TNV, which is somewhat similar to the HGTV. In addition to the cable networks, which they are both a content provider as well as a content producer, that meaning that most of the shows shown on each of these channels are produced by Scripps Network or under contract for Scripps Network, so they're producing the content. They also have online and mobile device sites, foodnetwork.com, for example, being one. So they are both a broadcast media, but broadcast into the new 21st century form of broadcasting, that being cable and, of course, available multimedia devices, as well as internet related companies. They make money both from advertising for the content that they sell, as well as fees paid by the cable companies and other entities that provide their content to the public. Next slide. This is just a glancing back at what the company has done as far as price and relative return over the last 4 years. It's the chronicle that you see at the bottom of your company page at Manifest Investing. The top green line you can see is just kind of my approximation of where the high the high par, projected relative return, par, projected annual return is, and as you can see, it is well above what appears to be the more or less historical high, which could present a buying opportunity. The lower green line is the projected relative return. So that is the par compared to my par that I was stumbling over. And again, the green line is roughly where it looks like kind of the historical peaks over time. And again, you can see that it is still well above the historical high, even though the company or the stock did take a bit of a bump in price in the latter part of 2015, and actually as of today they would be both the par and the relative par is a little bit higher because the stock price is down a few dollars in December, and the last bar there is for November. Next slide. And this is just my judgments for Scripps Network, which as far as the bottom line tracks just about right in line with the manifest Solomon defaults. I think my sales growth is a little bit lower, my net margin is a little bit lower, and my PE is slightly higher. And so it all works out to a 17.4 par, which I believe manifest is around a 7, between 16.5 and 17 on the par before today's close. I haven't seen what it was after today's close. So that you can see is are my judgments. Just very quickly, the sales growth is right in line, a little below the historical, but right in line with what the company and the analysts tend to be projecting for it. Value line sees some significant potential for upside surprises, largely as a result of the international expansion of the company, the Polish network that I mentioned, and also the company right now is producing significant amount of cash flow, which they are using to buy back stocks, which buy back shares, which of course helps bolster potential earnings growth, and you can see that in the share projections from roughly 128 million today down to about 120 million. Value line is projecting over the next 3 to 5 years, and that may actually be a little on the high side given what they've been buying back, but again, that's always nice to be pleasantly surprised rather than count on it. And then the profit margin I'm projecting to remain about the same with a little bit of margin improvement. Again, some of the analysts believe that there will be more significant margin improvement as the broadcast environment improves a bit and advertising rates go up, but we'll just wait and see what happens there. But a good solid 17.4% return, and just since I did use the yellow choice to highlight, do realize that that is still in the sweet spot. The 17.4% is not a yellow. You know, it's not above 10% over my par. So that's my pick for the month.
Okay. Thanks, Si. I think a lot of people here are familiar with the Food Network and some of the other properties that Scripps delivers. Any questions or comments at this point, or shall we hold them, Ken?
We're staying up pretty well. Mark, I want to relate a personal Scripps story to you real quickly. I was a paper boy from 8th grade through 12th grade delivering the Cleveland Press, which was a Scripps newspaper in Cleveland, Ohio. The grandson of the original Mr. Scripps went to my church, and every year the Scripps papers would give a $4,000 scholarship to 25 of its paper boys. So the Scripps Networks, or the precursor to the Scripps Networks, actually paid for my first year and a half of college, and I go out of my way to thank them every single time they come across my radar. They were very instrumental in helping me become the first person in my family to go to college, so I appreciate it.
I remember you mentioning that when you showed me your paper route on the last time through Cleveland.
Yeah, that's when you still could deliver on a bicycle, 60 or 70 newspapers and make enough to buy your clothes and everything else. $4,000 paid for a year and a half of college at a private school in Southern Ohio. So you can tell how old I am by the private variation.
Right?
Yeah, let's talk about my choice. Okay, it's Buffalo Wild Wings. I chose this back in July, and I'm going to choose it again. Most of you know Buffalo Wild Wings, the restaurant, and if you'd click the slide, Mark, and click again. I love their motto, wings, beer, sports, and it's a registered trademark. That's the motto of the entire company. They make a lot of money. They make billions of dollars selling basically chicken wings and putting lots of TVs on the wall so that people can gather and watch sporting events. Click again, please. Their restaurants are located all over the United States. They have a number of restaurants in Canada. They have a few restaurants internationally, but they're basically a North American chain. What's interesting is that right now Buffalo Wild Wings is making a concerted effort to buy out their franchisees. They are doing everything they can to turn franchised restaurants into company-owned restaurants. One of the biggest reasons that they're doing that is that the profit margins, the growth potential, the same-store sales are all significantly larger in company-owned restaurants versus franchisee-owned restaurants. When we get to the financials, you're going to see what impact that has had on the company recently. But in the long run, I think it's a strategy that's going to prove very lucrative for the company. Click again. You can see where their money is made. They make about half of their profit at dinner. It's not a place my wife and I would consider going to dinner, but it's an extremely popular place for the 20 and 30-somethings around here. My grandkids, whenever we ask, where would you like to go, Buffalo Wild Wings is always one of the top 2 or 3 restaurants that they name. You can see they make about 1/5 of their profit in alcoholic beverages. And another 1/5 in traditional wings, and another 1/5 in boneless wings. So chicken prices are very important to this restaurant. That's over 40% of the food they sell tied up in chicken. Click again. I did mention that they were expanding overseas, and you can see that they've moved some restaurants into Mexico. They have a single restaurant in the United Arab Emirates, one in Saudi Arabia, one in the Philippines, and they will be moving into Europe. That's part of their long-term plan. They'll be moving into Europe in the next 5 years. As of yet, I don't think they've opened a single store in Europe, however. Click again. Buffalo Wild Wings also has 2 other franchises, 2 other brand names that it's rolling out across the country, and both of these brands are growing more rapidly as far as store count is concerned than the traditional Buffalo Wild Wings restaurant, although the traditional Buffalo Wild Wings restaurant is also growing fairly rapidly by store count in the United States. The first new brand is Rusty Taco, and the other is Pizza Rev. Pizza Rev is a place where you go in and you basically make your own pizza, and then they cook it for you. Rusty Taco is, you could visualize Chipotle Mexican Grill, and you're looking at Rusty Taco. It's a direct competitor of Chipotle. Click again. Thank you. Here's Rusty Taco's logo, or their motto that they're going to use as a catchphrase. Tacos, the most important meal of the day. Click again. And here's these Pizza Rev places where they have these huge wood-burning fires, and you can see that the ingredients are kind of like a Subway or one of the sandwich places where you tell them what you want to throw on your pizza, and they throw it on, and then they cook it for you. Click again. Here's the most recent value line. The timeliness rating for Buffalo Wild Wings is 2, but if you go to the website, it's been lowered to a 3. You can see that they're talking about a low total return in the 5% range, high total return in the 16% range, and you look at the growth rates, and they've been pretty healthy in the past 5 years, but as the company grows and matures, you can see that the growth rates are definitely going to slow down. These are still excellent, excellent growth rates for a company as large as Buffalo Wild Wings. Click again. I'm looking at the traditional up straight in parallel. I would call Buffalo Wild Wings, and I do own this company in a couple of different portfolios. I would call it a core holding, and I would want to know what's happening to the earnings in the last couple of quarters. I can tell you that they've had three major issues. The biggest issue is chicken prices. Chicken prices have moved up considerably, but they peaked around July, end of July, and they are now moving back down again. Wing prices are moving down again, and that will help the earnings recover. The other two issues, number one, Buffalo Wild Wings has been hit with taxes about 6% higher than anticipated and than their average tax rates this year. And the other thing is that I already mentioned that they've been involved in buying back some of their franchisees' holdings and turning them into company stores. That's taken 15, 20, 25 cents off of some of these quarters, depending on which quarter you look at. You can see that the analysts are optimistic that as we go forward, that decline will reverse itself, and then we'll begin moving back up to match the sales increase again. The sales have stayed pretty consistent, and because chicken wings have been going up, you see a reduction in margins because of those prices, the taxes, and the money being put into the purchase of some of these stores. Click again. My SSG shows pretty decent profit margins for a fast casual restaurant. Those compare very nicely to other fast casuals where you're sitting down and actually being served by a server. Return on equity numbers are extremely nice, and especially with no debt, that means those numbers are pretty accurate. My SSG shows a return of somewhere between maybe 11 and 15%. I'm very comfortable with that, and I think that's a really good return for a company of this size. I would be very pleased to get a good solid 11% out of this company for the next 5 years. Of course, I'll take 15 or 16 if it comes to me. One more click. And I compare it to where Mark is. The only difference between my analysis and the default, and you're looking at the default analysis in the Eagle on Manifest Investing, the only difference is I'm not quite sure that the sales are going to grow as quickly as the analysts have indicated in Mark's analysis. They have a 17% annualized sales rate. I'm thinking that I would be more comfortable in the 14-15%, and that will of course change some of the numbers. Mark's projected return, however, does come out to be well within the range that I set on my SSG on that 11 to 15%. So I'm getting some validation from Manifest as to how accurate my SSG is, and I'm pretty pleased with the results. I think this is a good, large company that can serve as a nice core holding going forward, and I'll nominate Buffalo Wild Wings for another addition to the portfolio.
Another round of beers. And wings.
And wings and sports. Okay.
Good stuff. All right, thank you, Ken. That'll be the second selection of Buffalo Wild Wings and show up on the repeat holdings list. All right, I'm going to close things out.
Mark, I'm going to answer one question. Okay, I'm going to answer two questions. One from Nancy, and she says, can Buffalo Wild Wings require franchisees to sell to them, or do they just have to make the deal so sweet that the franchisees will sell? Right now, they're in the process of picking up restaurants that franchisees wish to sell, Nancy. They haven't stated their go-forward philosophy, although long-term, they've indicated that they're much more comfortable with company restaurants rather than franchisee restaurants as far as profit margins and earnings are concerned. We have a question from Ed. He goes, what about China and Buffalo Wild Wings? I don't think that's in the near future for this company. I think they're focusing right now on growing their full potential in the U.S., and they feel that there's the potential to almost double the number of Buffalo Wild Wing restaurants that currently exist within the country. So they're in no hurry to move out into the world, especially into China. I did indicate that Buffalo Wild Wings indicated that their next major target might be a couple of stores in Europe, but they are really focused on North America, where again they feel they can almost double the number of stores that they currently have.
Good to go, Ken?
I'm good to go.
Okay, and again, if anybody wants to bring questions on any of these companies in the Q&A here in a few minutes, that they're certainly welcome there too. All right, I'm going to go through this fairly rapidly. This is a company that's going to be fairly familiar to many of you people. Mesa Labs is the name of the company. The ticker symbol is MLAB. It has been selected 3 times at the round table already, so it's a repeat selection. Just this slide is just simply for the up, straight, and parallel. It has its moments. Again, with the loss of BioReference Labs, I would almost compare this company to almost a combination. They don't do the same thing. Don't anybody jump all over me on this. But BioReference Labs, Neogen, those type of companies, I think this one fits into that same type of category. And it's one that has served us very well for many years. This is a very small company, under $100 million in annual sales. And they just seem to do very high quality work. So let's talk about them. But I did want to give the audience just a real quick look at some of the companies where I went shopping, being the shopping season. Here's 12 companies that showed up on our Christmas countdown this year. Again, just from top to bottom, lo and behold, Scripps Networks is at the very top. We talked about Forward Air last month, Cognizant, a many times selection, Skyworks. These are companies that have all been presented here. Maximus, Stericycle, there's a great presentation by Nick Strategos out of Pittsburgh on Stericycle on YouTube. You can check that out. That continues to be a compelling company on the environmental slash healthcare cleanup type side. Waddell and Reed continues to seem to be doing some fairly interesting things, all the way down to one that I've selected at least 4, maybe 5 times for the roundtable, Apple, and it's actually performed quite well, even though the price has been lackluster here fairly recently. I know Ken has had a couple clubs interested in oceaneering, hoping to benefit from the same thing that he was going to cover when he says ultimately one day prices at the pump will actually go back up, and I think he's probably right about that. Another place that we wanted to bring to your attention is every Friday, basically, we put out our 5 favorite stocks, and we show a number of parameters, call it the long and short, the long-term perspective from manifest investing via the analyst consensus, but the value line, low total return forecast, and the Morningstar price to fair value and the Standard & Poor's price to fair value are the long-term outlooks for the companies. And we compare that along with the outlook for the next year based on the target prices that the analysts, both at the consensus and then in the case of Standard & Poor's and Goldman Sachs, they put out. So again, I think it's kind of fun to find a company with a really good long-term outlook along with a potentially turbocharged outlook for the next year. And some of those fit that description. In fact, Apple was my 1B pick for tonight, just simply because down in that approaching a price of around $100 a share, the long-term return forecast is in double digits, and Morningstar and S&P have it at a 20 to 25% discount, and Standard & Poor's and Goldman Sachs agree that the next year could be a pretty powerful one for Apple. So again, 1 year, kind of hard to predict, but we really do like some of those long-term outlooks. DIX looks kind of attractive, but kind of worried about another shoe dropping or something there. But kind of watch those. Again, we put these out every Friday. It could be something which would nudge you into studying something that you could have some fun with. But this is where I really turned, and we covered this last month, but again, in the spirit of the Christmas season, I thought this one was worth a repeat. This is the stock contest that Ken runs with a number of, literally a couple dozen investment clubs in the Mid-Michigan chapter. and he collects up their consensus selections every year and then keeps track of how that does versus the stock market benchmark. It's actually beat the benchmark 11 out of the last 12 years, and these are the selections they made this past, call it Halloween/Thanksgiving, for the 2016 calendar year. These were the companies that they picked, and $100 invested into each one back about a little over a month ago. And you can see that Illumina is already up. That was, by the way, that was Ken's roundtable pick from about, what, 4 or 5 months ago, Ken?
Yes,
Illumina,
yes.
that's up 31, almost 32% since then. Diplomat Pharmacy is kind of a real homer pick. That's a company out of Flint, Michigan. Diplomat Pharmacy, again, very small company, but they seem to be doing some fairly capable things. All the way down the list, now, a lot of very familiar names. But one of the things I like to do is, again, these companies were all very highly thought of by this group of successful stock pickers, many of you in the crowd. And the ones at the bottom of the list are the ones that have not performed that well in the last 6 weeks. So again, short-term, lackluster performance, but good long-term outlook, and in many cases, good one-year outlook. And that's where I see Mesa Labs, down 15% in the last 6 to 8 weeks. Pretty steady story. I like it a lot. I like Polaris a lot. And Polaris might still have a little bit of room to fall, but again, I like shopping down here where these have been beat up a little bit and might have a little bit of room to run to the upside. So let's talk about Mesa Labs. As Ken always suggests, and I like to reinforce, if you go to mesalabs.com, click on corporate, and click into this presentation, who are these guys? You'll get a description much better than I could give, but again, what they basically do is they make stuff. They make laboratory stuff and measuring and metering and monitoring equipment for pharmaceutical type things. I imagine Hugh McManus runs into them on his day job. They do things in food preparations, safety, quality, all of that type of stuff, anything that involves sterilization. So again, I see a lot of, Neogen type characteristics here. And again, from food preparation to drug to the wide gamut, right down to right in the lab. And you can see that this young man actually presents who is Mesa Labs in 2 minutes and 12 seconds on YouTube. And again, you just get a little snapshot of what they're into, and you can become very familiar with the company very quickly. They're basically in a lot of things that affects a lot of us. So here again is a look at that picture. Again, some of the equipment across the top, monitoring equipment, some of the biological indicator type stuff in those vials on the right. That's what they do. They provide it to a whole bunch of major food suppliers and drug companies, etc. So we're talking about a company with annual sales right now, trailing 12 months of about 84 million, growing in the 20% range. That's the red trend line. So a 19 to 20% growth rate. Again, very small company. Their projected net margin could be argued in the, again, high teens, 17%. And the other key indicator, the last judgment milestone, is the average PE ratio. It'd be really easy to argue for something higher than that. 20 is actually fairly conservative. So again, we're talking about a company with an upper double-digit, high teens growth rate, really strong, consistent margins after a little bit of an acquisition and a little bit of a test. 17% margins going forward, 20 time multipliers for the PE ratio, and literally a little bit of dividend, and a company, again, like Ken was talking, we don't have to reach for the moon here, but 14% would be good. If they come in at 20 or 25, I'd be really thrilled. The company was selected by Ken and the audience back in December 2012 at a stock price of $47.13. You can see that it's now at 93. I believe it actually shot up to 96 today. That actually beats the market by 12% over about 4 years. That's annualized per year. It was selected again in October 2013 at a little bit higher, but that still beats the market by nearly 10 percentage points relative return. So kind of, it's obviously been a company that has delivered and done well. Here's a look at the profitability and the valuation, or PE characteristics going back. These guys are not in the value line standard edition. They're in the small and mid-cap edition, so we don't have that long-term 3 to 5 year estimate, but you can see that the the margins have been maturing. They have been picking up other companies, which again kind of drops their margins down. But as they bring them into the fold, that a fairly major acquisition last year, which accounts for some of that drop in the net margin, they do seem to be stabilizing in that mid-teens area. Natural growth for a company as they come out of the starting blocks and exploit their field of opportunity. Same thing on the PE ratio. It was a relatively undiscovered company 10 years ago. It has been somewhat discovered by the analysts. A few more analysts cover it now than used to, and hence the PE ratios, which again is also a sign of respect, have been on the upward slant. We would expect that to moderate and plateau somewhere in that 20-ish area going forward. So again, PE or net margins in the high teens, PE ratio around 20. All this stuff seems to be relatively consistent to me. Here's a look at the Chronicle as Cy presented it. Again, a little bit of a dip in quality, but strong quality going forward. By the way, Value Line just raised their financial strength from B to B+, so you're actually going to see an uptick in quality when December lands on this chart. I've actually added December to this chart, showing that the price has actually dropped down in December. That's the dip that you see right here. I colored in this yellow area just to show where the price has gone. The return forecast has actually jumped up into the low 20s as a result of that price drop. The fundamentals are still intact, as you can see from the visual analysis. So I'm basically going to bring Mesa Labs as a repeat selection. They're just leveraged and very capable, very competent in what they do. And for me, just a real, genuine, solid, smaller company delivering some growth and consistent results. So with that, Ken, I think we'll go ahead and switch gears to Hugh. He's got plenty of time left to take us into the world of petroleum again.
Yes, I love oil. So I'll move through this one reasonably quickly. The pick tonight is BP. Skip to the next slide. We'll go through what I normally do, which is to look at a bunch of companies. I like building a portfolio, that's my biggie. And I order them by how close they are to their 52-week low. So looking at a range from the 52-week high to low, Johnson Controls at the moment is within just over 2.5%, whereas Apple is closer to 40% of its 52-week low. And if you go to the next slide, I've added in quality and par because ultimately you want to try to buy a quality company at a reasonable price, the 52-week low being one indication that it is at a reasonable price. There are others, obviously. And quality and par is taken from manifest investing, the projected annual return being par. Not surprisingly, companies closer to the 52-week low may have quality issues as well. And BP jumps up as a company that has one or two problems with quality rating of only 33. Interestingly, it has quite a generous dividend yield of 7.53%, but there's a little bit of a caveat here. As of, I believe, January or 1st last year, maybe somebody can correct me, it did start charging a dividend fee on the ADR, and the fee is, I believe it's 0.5%. It gives a nice way of getting around paying that fee, but if you were to do it, there's a way to, I think, have a deposit agreement of some kind, but they charge, instead of 0.5 cent, they charge 5 cents for that. So probably not a good move. And it may not be a qualified dividend as well, just a heads up on that. But moving on to the next slide, I just summarize here that around this, if we move on to the next one after this, the next slide, I kind of favor companies I already own. I have a tendency to avoid retailers around the Christmas season, the holiday season, because they tend to be a little bit unpredictable. I am digging into Staples, so I'm not looking at that one right now, but digging into its numbers. And so blanking out those, which I've done in slide 38, you're left with BP. And so that's the company I picked this evening. And as you know, BP on the next slide is in the exploration. This is the top of the heap. These are the companies that are nearer to their 52-week high. So not surprising, some of the numbers there. Amazon, Kimberly-Clark, McDonald's, etc.
Pretty strong.
McDonald's not serving breakfast day round. Rescued itself doing that. BP is in all major sectors of the oil industry: discovery, distribution, and retailing. And it also has activities in a thing called Rosneft, where it owns about 20 or 25%. A big chunk of that is in Russia and Ukraine. It's suffering there at the moment. So there's upside potential there when Russia starts behaving itself and stops bullying people. Things might improve there. On the next slide, I'm just going to look at the financial statements very, very briefly of BP, and these are taken from Yahoo for people familiar with the site. You can see that it's comparative over 3 years. Company's doing fine. Its assets are, its cash and equivalents are growing nicely, whereas its long-term current assets have been dropping, as have its total assets. And it's been divesting itself of some of its holdings, partially in response to the fines, etc., that it's gotten from polluting the Gulf. But the interesting thing here, and I'm delving into this number, and if anyone knows the reason, please let me know, is the fact that its inventory numbers are so low and dropping. And just, you know, in this industry, when you hold things like oil, particularly if you hold them for trading, you have to price them at the lower of purchase price or market price. And recently the market price has been dropping. So that can account for some of the drop, but certainly not all. And you don't see this as manifesting itself as dramatically in companies like Chevron or ConocoPhillips. So it's a number that I'm plowing into in a little bit more detail to see what's going on. The next slide just looks at the income statement, and there BP income has been dropping, but again, sorry, the total revenue has been dropping, but that's predictable as it divulges itself of some of its assets. And its operating income has been in decline as well. But again, there are good reasons for that and nothing to get concerned about. A lot of its revenues actually are coming from the US, which is a pretty strong market. And again, cash flow statement, you can see that the operating cash flow on the next slide kind of mirrors what's been going on a little bit. It is actually growing, so it's going counter to what you would expect in on its earnings, but the fact of the matter is that its changes in liabilities are improving, and its changes in accounts receivable is improving as well. So now we skip on to the next slide, where I'm kind of justifying why people shouldn't really worry about what's going on in the oil industry. I know the prices have been headed lower, and I think that's been very, very predictable, but they will bounce back again. The fact of the matter is that oil has been the future prospects for oil have been very predictable over the long haul, whereas short-term pricing has not. And as you can see from this chart, and I've showed this chart before, it's from Murphy Oil Corporation, it indicates that consumption of liquid energy will increase, that is oil, as will natural gas, coal, but probably not as dramatically. Nuclear will probably climb a little bit, and certainly there will be growth in renewables, but we will still see increase in oil. Move on to the next slide. It really shows that despite all of the things you hear on the news, and anytime a reporter gets a microphone in front of his or her face and is in front of a gas station, everyone seems to pay attention. But a lot of what they say is kind of nonsense a little bit. The fact of the matter is the sky is never falling in the oil industry, and whereas when the prices do drop, the prices also surge. It makes for great TV coverage. The sad fact is, the boring fact is, that what governs what happens in the oil market, and you and I, all of us are participants in that, is supply and demand. We buy a little bit less, but not a lot less when the price is high, and we buy a little bit more, but not a lot more when the price is low. The world economy depends on oil and will continue to depend on oil. And 90% of the chemicals that are used in the chemical industry that you find right throughout your house in the goods that sit under your sink, in the coverings of your seats, coverings of carpets, curtains, paints, etc. 90% of those are derived from the oil industry. It's not going to go away. Demand, as I've kind of pointed out, is relatively inelastic, despite the fact that it claims that people will drive less when the price goes higher. They will drive less, but just a little bit less. There's not a dramatic shift. And it tracks pretty nicely, and the long-term trend, as you can see in this just 20-year chart, is up. Move on to the next slide. we can see that one of the big drivers will be in emerging markets, and I'll show you a slide later on that point. These are the famous countries, which consist of Brazil, India, China, and Russia, the higher growth companies, and these are for charts up to 2011. The actual auto sales in China haven't grown recently as dramatically as people predicted, but they are growing and growing fairly substantially, as is the freeway system there. So cars will continue to be on the rise, and most of them will be gas-powered, gasoline-powered. On the next slide, we can see where the projection is for growth in oil. Over time, the developing world will grow most dramatically. Industrialized will continue to grow, but it's the development world where the consumption will be the largest. And move on to the next slide, we can see that we're going to look at oil producers from, I'll show it from 2008, and we can move through the next few slides quickly. But in 2004, Saudi Arabia was the biggest. This is 2008, move on to 2009. You can start to see the US climb, and we can just keep moving through 10, 11, 12, and then really when things started to kick off in 13, and last year 14 is where the US surpassed Saudi Arabia in producing oil. The fact of the matter is there's a lot of oil around the place. Increasingly it's in inaccessible regions of the world, but fortunately technology keeps improving to make what was once inaccessible a reasonable place to start looking. And countries like Kuwait, which we all believe and does have quite substantial oil reserves, are not major producers compared to countries like Russia or Saudi Arabia. And if we skip on to the next slide, it just summarizes who are the big guys and who are the small guys. Look, they've got it all out of alignment there, but the big shocker here is that Venezuela on slide 57, which didn't appear in any of the previous charts as being a major supplier, has by a large margin compared to some of the major producers today, by a large margin, the largest oil reserve, 296 billion barrels. Right now we're consuming 96 million barrels globally per day, a quarter of that in the US. But it surpasses Saudi Arabia, and the US is about 12th on this list. It's not here, it's about 30 billion barrels, same as China. China has quite substantial reserves as well. And on the next slide, just mirrors what I said. Countries that are doing most consuming, you can see the US is going to be flat. Energy conservation, more efficient cars, the usual things, shift to natural gas in some areas, especially and changes in what the trucking fleet is doing. Not so much electric cars, that might be a thing way in the future, but the growth is in China, it will be in India, and maybe in the former Soviet Union, the former Russian countries. So moving on to the next slide, this is just to show you that oil is here and it will stay. Demand is growing and it continues to grow, and the big push is in the developing part of the world where people, not surprisingly, want to follow the same path as you see in the Western world in terms of consumption of goods, use of cars, houses, etc. It will keep going. Companies such as BP and all the companies in that space will continue to get buffeted by problems in the oil sector, problems in producing countries, because most oil tends to find itself in the part of the world where there is political instability, Iran, Nigeria, Venezuela, all of these types of countries, Middle East, which is in turmoil periodically. There are accidents which can rocket the price up and down, and economic downturns which can impact oil industry as well. But the fact of the matter is, long term, there is steady growth. That's why I like oil. And then skipping on to the next slide, and I promised we'd be fast. I believe that the oil price will hit a floor soon. Once it hits about $30, it takes out a lot of the marginally producing wells that are in the U.S. and it has, right now, it has taken out easily the incentive for further discovery. All of that has gone by the wayside. A lot of capital investment has been cut back quite dramatically. So it is sorting itself up, but it does take time. BP has a very strong presence in the U.S. market. It's in a very good position. It has a very strong discovery and exploration culture, which should continue. And I think it gives a good return to shareholders. So I bought BP maybe for this portfolio about a year ago. And now I do want to add more BP to the portfolio. I see its timiness is looking pretty good. Pretty bad, rather. But
He loves it.
For me, the timeliness of this company is actually quite perfect.
Yeah, one thing to note on here, you could use a price to cash flow analysis if you wanted to, if the earnings going away bother you. But Value Line does have this with a low total return forecast of 15%. That's certainly pretty hefty.
So that's what I'm going to add to the portfolio this time. More BP.
Okay.
Promised I'd be fast.
All right, let's go ahead and, Ken, I think we can probably go ahead to the audience poll, and then after that open up for questions and answers if you would like.
Okay, here comes our poll, Mark. All you need to do is use your mouse and click on what you think would be a great company to add to the portfolio.
Now, I wouldn't want anybody to get the heebie-jeebies or anything, but Santa has already begun work on his naughty list for the coming year. And we do keep track of who votes for what. No, I'm kidding. I'm kidding.
We're up to 80% voting. I'll give you just a few more seconds to make up your mind.
You're talking about naughty list, Mark. I think you were naughty in you're pushing for Mesa Labs, calling them like BioReference, which was a favorite of some of us.
It's presidential campaign season, Si. Anything is okay to say.
You need to get a new hairstyle if you're going to say anything, Mark, okay?
What, Hillary? I'm not going to say that. I'm not going to go there.
I'm going to close down the voting and share the results. And Mark, you won one for a change.
Oh, holy mackerel. It is the dawn of a new year. Really? Wow. Very impressive.
So we're going to add a position in Mesa Labs. Looks like pretty much of a dead heat between Buffalo Wild Wings and Scripps. Few people just aren't convinced about buying oil stocks yet, but
well, they will be when the price is high.
Talking. When the price is high, they will be. Okay.
Back when it's the wrong time. Yeah, it's.
Now we have the eggnog factor. Mark wins.
There you go. All right, as we're getting ready to open up the floor for Q&A, we are going to be making some appearances here in the next few months. We'll take a few more days off to celebrate the Rose Bowl and things like that. But we're going to be in a couple of different places, including Grand Blanc, Michigan in the middle of January for a workshop where we're just going to talk about successful long-term investing. We are going to try and do the roundtables, as you can see, in January and February. They're on the last Tuesday of every month. And we'll try that for a while and kind of do the investment club thing of locking in on a specific time so that everybody can get used to that and stop moving it around so much. Just try that for a while. We may go back. We are going to be in Orland Park for an entire day session on January 30th. Really looking forward to that. Ken, would you like to talk a little bit about the National Convention?
Well, we're going to be in Chantilly, Virginia. That's just outside of Washington, D.C. Mark will be there. I will be there. Cy will be there. We think, right, Cy?
Yes.
And Hugh, you'll be at the National Convention as well, won't you?
Yes, I'll be there.
Well, they've asked us to do a roundtable live at the National Convention, so we'll be coming to you live from the National Convention in May. Mark, I'd also like to just give a plug for the folks in Sacramento, California. I'll be speaking at a workshop there on March 12th. That's always very well attended. It's a morning session. It's a Saturday morning. So if you get a chance, if you go to the Sacramento page of the Better Investing website, I'm sure there's registration information available. That's on March 12th in Sacramento, California.
I'll add that to our events listing also so that people know that you're going to be out there with them, Ken.
Okay. And I'm going to go to the questions now, Mark, and try to get through a few of them. I'm going to handle this first question. It's from Jane Johnson, and Jane says, could someone please explain relative return and how important is it? Jane, it's very important if you're really going to be an investor that thinks they're actually accomplishing something. think of putting your money in an index fund and think of the number that comes from putting your money in an index fund. Let's say it's 10%. Over that same period of time, look at what your investments have done. If they've done better than 10%, then you have a positive relative return, and that means what you're doing is doing better than the market as a whole. If you have a negative relative return, if it's a small negative return, then you're matching the market. But if you have a large negative return, maybe that means you need to reevaluate some of the things you're doing as an investor. Relative return just means by how many percentage points have you beaten a passive investment? And the passive investment we measure ourselves against is the Wilshire 5000 Index Fund. Now, you can't just look at how much it gains and loses. You have to look at deposits in and out. If you belong to a club, you might look at the report that comes from the benchmark reports on either the BWLD club accounting or the club accounting coming from boy, oh boy, a brain freeze right here, coming from iClub, okay? And that will always tell you the relative return of your club. If you need more information about that, drop me a line or give me a call, and I'll be glad to spend some time discussing it with you. We have a question from Susan, and she says, Mark, do you know why the most recent quarter's earnings, and this is in Mesa Lab, were so depressed, and why the profit margin has dropped so much?
Let's take a quick look. I do know that they did have an acquisition last year where they were taking some charges, and that has caused a little bit of a disruption along with just general economic weakness. But let's take a look at more recent quarters. They also must have had an unusual item a year ago in that second quarter. Would actually be the second quarter of the previous year. You can see the 84 cents. Let me try to bump this up a bit. Again, the first quarter wasn't too bad. I'm not sure how the third quarter came in recently. I did notice that the numbers had come down in the same place we always check. Let me jump over to Finance Yahoo. And as I looked at it, they did explain it with acquisition and, just basically merger type related stuff. I'm sorry, I grabbed the wrong one there. They're working through a merger, basically, what it comes down to. So let me show you. One of the things that I did notice is even though the analyst estimates had gone down for earnings, sales had actually gone up, which I found kind of interesting. We're going to the analyst estimates for Mesa Labs for next year and the year after, and this is probably what she's referring to. They had trailed off a little bit here in the last quarter, but they're still actually pretty respectable. And again, if you go back to my graphic, I think they basically came back to where they originally belonged. The expectations were pretty robust. In other words, unprecedented net profit margins, that sort of thing. And if you look at the actual slide in the presentation, the coverage of the company, let me go back to it here, I think, at least my instinct is they literally just kind of came back to where they belonged. They were up there where the arrows were. It's kind of my take on the whole situation from 35,000 feet.
Nancy, Hugh has a question for you. She wants to know, do you think BP is the best of the oil stocks? Hugh, you might be muted.
No, I'm here. It just took me a while to get muted. I think they're all all pretty similar. I mean, it's hard to know which. Is there a major difference between ConocoPhillips and Conoco and BP, or between BP and Chevron? I've been buying all three, and I just buy the one that has the lowest price, if you will, compared to its 52-week average, or compared to its earnings. So, yeah, they're all, to me, they're all pretty. I haven't really never bought ExxonMobil, but I own Chevron now, ConocoPhillips, and I own BP. And by the way, I like companies that have a large exposure to exploration, because they're the ones that are getting hardest hit.
Okay, Meg says, tell us about the Alaskan cruise. Meg, I'm going to advise that none of the four of us are actually directly involved with planning that cruise. We're just publicizing it. If you want more information about that Wall Street on Water Alaskan cruise, I would try to contact the Puget Sound chapter of Better Investing to get more information. But none of us are directly involved, and I'm not sure that anybody would be comfortable giving you advice. Mark?
That's not quite true. We're actually committed. Wendy and I are actually going on the cruise.
All right.
Okay, so we actually made that decision, and I know Christy Powell's going also, and they're finalizing the teacher stuff. I call it a bucket list situation. We're going to have an article on it at Manifest Investing here in the next couple of days. That's why Ken doesn't know about it. Plus, we've been off for the holidays. But Ken's right. It is actually administered and managed by the Puget Sound volunteers for Better Investing. They did do a pilot cruise a year ago where they kind of got the kinks out and streamlined it. And I just see it as an opportunity to kick back. It's on my bucket list to get to Alaska anyhow. I've always wanted to do that type of a cruise. And my wife wants to go along too. That makes it a double bonus, not just for me, but for anybody that would happen to go, because she's more fun than I am. As Ken can attest to that. Well, all three of the guys can attest to that.
She's a better card player. So.
is that. That's true. But it really is just an opportunity to spend some high quality time. There'll be a number of classes and also a lot of recreation, but it's literally just a national convention like Chantilly on steroids, where you're doing it for a couple more days and can probably do some pretty neat exploring in the world of investing, depending on where you're at in the spectrum. So again, if you want more information, contact either me or contact the Puget Sound folks and get more information. We'd be happy to share it with you, and really look forward to it.
We have a question from Kate. She says, what's the current feeling about precision cast parts? Would you sell at the market price right now or wait for the $235 buyout to actually occur? Anybody want to take that one?
I'm actually not familiar exactly with what the buyout offer is. Anybody else out there?
All I would say, Kate, is that in the recent past, we've decided within the roundtable portfolio that when an offer comes on the table and the stock price stagnates at a very close to the buyout price, we've been kind of eager, I guess is a good word, to sell it rather than wait for the possible dissolving or falling apart of the deal. So, but I don't know if anybody has any precise information on this particular buyout. Si, were you going to say something?
Well, I was just going to say I noticed I'm not familiar with this particular buyout, but the only reason that I would see hold or continuing to hold in this case, because the price is within $3, which at this stock price is what, about 1%, a little less than, I guess actually slightly more than 1%, is all that you would be gaining. So unless you have reason to believe that there is some significant chance for a bidding war, there's no reason in this case to hold out for the buyout. I mean, you just mentioned the downside, Ken. If you know, any trust review or just due diligence, you know, any one number of things happen and the buyout doesn't go through, then I'd see no reason to wait for it. I guess the only other possible reason in this particular case, since we are at the end of the year, is depending on your tax circumstance, you might want to wait until after the first of the year just to defer your gain. But if it's in a tax deferred account, that would not be important.
Yeah, and it's just like Ken said, here's a look at Staples. When the FTC decision with the Office Depot came in, the price basically went back rather suddenly to, I mean, at one point it was up in the $17 to $18 range, And at the time of that decision, it literally slumps back down. In this case, it went from 12 down to 9 literally overnight. In the case of PCP, which is a great company, it was in the Mutual Club of Detroit portfolio. I can remember reporting on the company. What would happen here is it's conceivable that that would drop back to the 180, 190 level literally overnight if the deal did, for some reason, fall apart. That's really what's at risk. So Si's right. I mean, you're 1% away from the buyout price versus a $30 or $40 per share drop in stock price.
Mark, I'm going to ask you to wind up the round table. We do have 5 or 6 other questions, and we'll stay and get those answered, but why don't we round up the recording right now so that we don't continue to let the recording go, and then we'll answer the rest of these questions, okay?
Okay, well, while it's still recording, I just want to say thanks to everybody, thanks to the attendees, but thanks to all you guys for pitching in and being willing to go out there and stick your neck out with the stock picks. And again, Merry Christmas and Happy New Year. Let's have a great 2016 and hope that the roundtable continues to chug along. So thank you all.